What if I told you that the difference between these two scenarios isn't luck, talent, or even how much money you start with? It's one simple decision that 90% of people never make. 3 years ago, Sarah was working minimum wage at a coffee shop, struggling to pay rent. Today, she owns a portfolio worth over $50,000. The crazy part? She started with just $25 a month. By the end of this video, you'll know exactly how she did it, and more importantly, why most people fail at investing before they even begin. But first, let me ask you something that might change how you think about money forever. Here's the question. If you could travel back in time and tell your parents to buy just $100 worth of Apple stock in 1997, how much would that be worth today? Take a guess. Write it in the comments right now before I reveal the answer later in this video. I guarantee your guess is wrong, and when you see the real number, you'll understand why starting today, even with pocket change, is more powerful than you think. I'm not here to sell you a course or promise you'll get rich quick. I'm here because I spent 5 years making every possible investing mistake, lost thousands of dollars, and finally figured out what actually works for beginners. Today, we're breaking down the exact step-by-step system that transformed me from someone who was terrified of losing money to someone who sleeps peacefully knowing my money is working for me 24/7. Let's be honest about why most people never start investing. It's not because they don't want to build wealth. It's because the entire investing world feels like it's designed to confuse you. You hear terms like PE ratios, dividend yields, market capitalization, and your brain just shuts down. Then you see people on social media showing off their massive gains, and you think you need thousands of dollars to even begin. Meanwhile, your money sits in a savings account earning 0.5% interest while inflation eats away at your purchasing power every single day. You're literally losing money by playing it safe. But here's what nobody tells you. The people making consistent money in the stock market aren't the ones making flashy trades. They're the ones who understand 3 fundamental principles that we're about to dive into. Principle number 1, time is your secret weapon, not money. Remember Sarah from the beginning? She didn't start with a big lump sum. She started with $25 a month because that's literally all she could afford after paying rent and groceries. Here's the magic. If you invest $25 monthly in an S&P 500 index fund averaging 10% annual returns, after 30 years, you'll have over $135,000. You only contributed $9,000 of your own money. The other $126,000? That's compound interest doing the heavy lifting. But here's where it gets interesting. If you wait just 10 years to start that same $25 monthly investment, you end up with only $45,000. Starting early isn't just helpful, it's everything. This is why that 22-year-old who invests $100 a month for 10 years then stops will have more money at retirement than someone who starts at 32 and invests $100 a month for 30 years. The math is brutal but beautiful. Principle number 2, diversification isn't just smart, it's essential for survival. Imagine you put all your money into one stock. Maybe it's Apple, maybe it's Tesla. Feels exciting, right? Until that company has a bad quarter, gets hit with a lawsuit, or the CEO tweets something controversial at 3 a.m., professional investors know something that beginners don't. You don't need to pick winning stocks. You need to own pieces of hundreds of winning companies simultaneously. This is where index funds become your best friend. An S&P 500 index fund gives you ownership in 500 of America's largest companies. When some go down, others go up. When the entire economy grows, you grow with it. Over the past 90 years, the S&P 500 has averaged about 10% annual returns. That includes the Great Depression, World War II, the dot-com crash, the 2008 financial crisis, and the pandemic. Diversification isn't about avoiding risk, it's about managing it intelligently. Principle number 3, your emotions are your biggest enemy. Picture this. You start investing, everything's going great. Your portfolio is up 15%. Then the market crashes 20% in 2 weeks. Your $1,000 is now worth $800. What do? Most people panic and sell everything, locking in their losses. Then they watch from the sidelines as the market recovers and reaches new highs. They bought high, sold low, and learned the most expensive lesson in investing. Smart investors use a strategy called dollar cost averaging. Instead of trying to time the market, you invest the same amount every month regardless of whether the market is up or down. When the market is high, your money buys fewer shares. When the market is low, your money buys more shares. Over time, this averages out to a lower cost per share than trying to time your purchases perfectly. Every market crash in history has been followed by a recovery that reached new highs. The investors who got rich weren't the ones who predicted the crashes. They were the ones who kept investing through them. Now let's talk about actually getting started. You need 3 things: a brokerage account, a simple investment strategy, and the discipline to stick with it. For beginners, I recommend apps like Fidelity, Charles Schwab, or Vanguard. They offer commission-free investing and low-cost index funds. Avoid apps that gamify investing or encourage frequent trading. Opening an account takes about 10 minutes. You'll need your social security number, bank account information, and basic personal details. Most apps will walk you through the entire process. For your first investment, consider a target date fund or a broad market index fund that tracks the S&P 500. These funds automatically diversify your money across hundreds of companies. Set up automatic monthly investments. Even if it's just $20 or $50, consistency matters more than the amount. You can always increase it later as your income grows. Treat this like any other monthly bill. Set it up to automatically transfer money from your checking account to your investment account on the same day every month. Remember that question from the beginning? That $100 Apple stock purchase in 1997 would be worth over $75,000 today. That's not a typo. A single $100 investment became $750,000. Now, I'm not saying you should put everything into Apple, but this shows you the power of long-term investing in great companies. The S&P 500, which includes Apple along with 499 other companies, has delivered similar life-changing returns for patient investors. The point isn't that you missed out on Apple. The point is that the next 25 years of wealth building starts with your first investment, which could be today. Here's what I want you to do right now. First, smash that like button if this video helped you understand investing better. Seriously, it helps more people discover this content. Second, subscribe and hit the notification bell because next week I'm breaking down the biggest investing mistakes that cost people thousands of dollars. You don't want to miss that. Third, drop a comment telling me what's holding you back from starting your investing journey. Is it fear? Lack of money? Confusion about where to begin? I read every comment, and your question might become my next video. One last thing. Next week, I'm revealing the 3-fund portfolio strategy that millionaires use but never talk about. It's simpler than you think and more powerful than most people realize. Until then, remember, the best time to start investing was 20 years ago. The second best time is today. Thanks for watching, and I'll see you in the next video.